Today, I am joined by Lyn Alden.
Initially, bonds did well. Bonds sensed out that crash coming. Bond yields went down, so bond prices went up. But during the heart of the crisis, as the dollar spiked, you had the foreign sector having to begin kind of force selling some of their treasuries in order to raise dollars.
Overall, it seems like if most people had their cost of living going down, that would be a good thing, and asset prices going up at the same time, that would be kind of a good thing.
So we've been in that kind of disinflationary commodity environment. While we had to target, inflation in asset prices, inflation in healthcare, inflation in education, inflation in childcare, things like that.
It seems like the big risk of deflation is in the markets. Like stocks could crash 50%, 80%. The real estate could crash 50%. And that's like a massive deflation hit.
I view policy tools and fiscal tools kind of like the two keys there when it comes to generating inflation.
If all you have is a hammer, the whole world looks like a nail, and they really only have a couple tools, and really it's monetary tools, and so that's kind of like interest rates and increasing the debt supply.
The Federal Reserve can't send money to people. All they can do is control interest rates, and they can increase the amount of bank reserves in the system.
Gold and silver, right? The physical is very difficult to get, and it looks like there hasn't been that much investment into that space, which of course we've been in a long-term downtrend bear market in that, so you haven't had that investment.
If you were betting on long-term deflation and you're willing to have negative cash yields, negative bond yields, but then you actually start to get increase in the broad money supply, you start to get disentangling to some extent of globalization.
There's a bunch of different levers out there, right? But the U.S. can continue their fiscal policies, which only hurts the dollar. We're already seeing the de-dollarization happening across the world. And now we're seeing the IMF kind of trying to roll out their own fiat currency that's like a layer above.
There's populism that can come on the right, there's populism that come on the left, and they tend to have actually a lot of overlap, even though there's different flavors of it.
Like a traditional financial advisor that might say, well, historically you would make 7%. Like those are kind of off, right? Like the world we're going into is probably not the same as the one that we're coming out of.
If you look at fourth turning, all the ones that the authors identified, all those periods of time that they identified as fourth turnings, those also happen with the end of long-term debt cycles.
You have to go back, I think, to the full cycle, and then maybe even look at that cycle played out a couple of times to see how that cycle played out.
This comes down to whether or not you're kind of finding the right policy mix to even have an idea of what you're looking at.
Pendulum cycle, where the world shifts from a we, which is like collectivism or globalism, and it shifts to a me, which is like an individualism or decentralization. The central bank's backs are against the wall. They're running out of tools. And what options do they have left? Should they save the bond market, or do they save the currencies? Now, there's no one better to take a look at what's going on with the central banks, the tools that are left. Will we face inflation, deflation, and the macroeconomic view than Lyn Alden? That's who I'm sitting down with today. We have been trying to put this interview together for a long time, and I was so excited to finally get this done. Lyn drops absolute fire. And if you want to know what is going to happen with the currency, with the bonds, but even on a bigger level, what's happening with the central bank digital currencies, and even one level above that with the IMF SDRs, digital currencies on that level, and then into traditional safe haven assets, including her opinions on gold, where that's at, and Bitcoin as well. We cover it all with probably one of the best macroeconomists analysts on YouTube today, in the market today, and that is Lyn Alden. So let's go ahead and just jump right into it. Hey everyone, welcome to another episode of the Market Disruptor Show. And today I am joined by Lyn Alden, who probably doesn't need much of an introduction. She is a macro analyst that's really been making a lot of noise in the scene, really good insights. She's the founder of Lyn Alden Investment Strategy. And Lyn, I'm so excited to have you on today. Thanks.
Yeah, happy to be here. Yeah, it's been a long time in the coming to finally be on your show. So I know we were planning on it a little while ago, and we finally got to make it happen.
Yeah, I am glad to make it happen. I've been watching your stuff for a long time, and yes, we've been talking about it. I'm also a paid subscriber to your newsletter, and I recommend that to everybody as well. To some great insights there. It's definitely helpful for me. But I know a lot about who you are. But why don't you give us a little bit of background of kind of what brought you here and what you're doing in the space?
Sure. Yeah. So my background is a blend of engineering and finance, and so I've had a lifelong interest in investing and finance. But when it came time to go to university, I focused on engineering instead, because I also a big fan of technology and kind of the importance that has on the world. And so I worked as an engineer, but then I kind of shifted more towards engineering management and running the finances of an engineering facility. And then over time, made my investment research. I started a company to focus on retail investing and institutional investing, for kind of that blend. So, a lot of businesses focus on either purely the retail side or purely the institutional side. Whereas one of my goals was to kind of make institutional level research like widely available.
Hey guys, let me just interrupt this interview real quick just to plug the show sponsor, and that is BlockFi. Now, BlockFi is doing amazing things in the Bitcoin finance space. As a matter of fact, they've cracked some really big news by bringing on the ex-CFTC chair, Chris Giancarlo, and they are one of the most transparent, most heavily regulated companies inside the United States, which gives me a lot of trust into what their services are. Now, I've recently did a video talking about how to retire off of Bitcoin, and you can do that by leveraging debt and interest against Bitcoin. And BlockFi is the number one company in the United States, or maybe in the world, to go to and use. They are leading the charge. They're paying interest on your Bitcoin if you park it with them, or you can borrow against it. Now, as I broke down in that video, you can borrow against your Bitcoin. And when you take debt against it, it's not taxable. It's not a taxable event. You can use that debt for anything that you want, including to live off of, to leverage up and buy more, or roll it into another asset. You can do something like I've done recently, like sell some real estate, put that money into Bitcoin. Now, as that Bitcoin price has risen, I'm able to borrow against it and go back and buy the same real estate or something similar. And I still own the Bitcoin, and I also own the new asset as well. Lots of ways you can do this. And BlockFi is the company that I recommend. Down in the description, I have a link that you can click on. If you choose to use that link, you can earn up to $250 in Bitcoin just for using that link. So check out BlockFi now.
Which is funny because even the institutions still like that because they actually can read it instead of like just pretending they can understand it. And so it's basically trying to present things in plain English, and so it's kind of appropriate for a pretty wide audience of skill levels. And so that's kind of my background. I focus on individual equities. That's kind of where my bread and butter was, as well as commodities. But because we're in such a macro heavy environment, I've had to incorporate a lot of macro analysis into my research, because those are some of the big trends that you don't want to be on the wrong side of when you're picking which sectors or which type of assets to be invested in.
Yeah, definitely. It almost seems like that bigger picture is easier to see than the shorter term picture, maybe as well. Having that engineering background, I haven't seen. I'm guessing you probably have. You done some interviews with Preston Pish?
Oh yeah, definitely.
Yeah,
Yeah, big fan of his.
yeah, another engineer in
Yeah.
the space. And I guess it lends to that kind of analytical thinking, right? Maybe that's one reason why you look at all the numbers and stuff makes sense for you.
That's the shared background. Yeah, it's a very quantified background. And just, I often, my background specifically was control systems. And whenever you have like say some sort of variable happens and kind of pushes the system one way, whether it's electrical system or mechanical system, the whole point of a control system is there's some sort of feedback response that generally pushes back the other direction and gets it back on target. And that's one way that I think about all the policy responses that happen. And so one thing
Mm.
that investors often miss is the policy response. And so they often, they look at the economy, they say this is going to play out, but then it's very hard to predict kind of the policy response that either central banks or fiscal policymakers are going to come in and push back on. Whereas one thing I try to do is incorporate the expected policy response that they're going to have, rather than kind of be caught off guard by it.
So kind of like chess, like playing a couple moves ahead. Like if this happens, the response will probably be this, which will then cause this to happen.
Yeah, pretty much.
Something like that. So let's go ahead and jump in, and I guess curious on what your views are on like the current stage that we're in, and a couple things that I think a lot of people have been looking at is bond yields have been going up pretty dramatically. Of course, on a long enough time frame, they're way down, but they're coming up. And it seems like there's a little bit of maybe concern there, and at the same time, they're printing trillions and trillions of dollars. We've seen the dollar index kind of crashing. That's been stabilizing as well. And it seems like maybe there's a little bit of a balancing act that the Fed is trying to deal with between the bonds and the currencies. Do you see that at all? Or what are you seeing between those two?
But yeah, I think so. I mean, we've gotten past some of the really extreme moves of last year, and so we have had a degree of relative stability, in recent months. That still could be somewhat fragile. You could say we can call this kind of a counter rally in some of the things. So a counter rally in the dollar, a correction in precious metals. That we've even had in the past month, kind of a correction in some of the digital assets as well. And so we kind of we can only kind of move so far so fast before you naturally have kind of a bounce back mechanism.
Right.
And so the big picture trend of where I see we are is towards the end of a long-term debt cycle. And so that's a concept that was popularized by Ray Dalio, but it's something that I've done a lot of independent research on as well, which is the idea that if you look at the short-term business cycle, the 5 to 10 year credit cycle, you build up leverage, then you have some sort of, either policy error or external catalyst, kind of tax that very fragile leverage system. You have a deleveraging, a recession, but then policymakers come in and they kind of short circuit that deleveraging process. So they cut interest rates, they do fiscal responses, and so that the economy never deleverages back down to where it was at the start of the cycle. So if you string multiple of those short-term business cycles together, you get higher and higher debt as a percentage of GDP, and you get lower and lower interest rates. And eventually that kind of compounds over decades until you hit the zero bound in interest rates. Then they turn to asset purchases as their next set of policy tools. But at that point, debt as a percentage of GDP is so high that if you have any disruption to cash flows, it can be catastrophic. And that's where you get some of the really extreme fiscal responses. And the last time we were in an environment like this was the 1940s. And so, we have, the 5 to 10 year business cycle, but then on top of that, we have this multi-decade kind of long-term debt cycle. And usually the big difference at the end of a long-term debt cycle is that you usually have some degree of currency devaluation. And it could be an abrupt one from high inflation, or it could be a more prolonged one of just holding interest rates below the prevailing inflation rate for a while, or you can have some combination of the two. And so that's kind of the overall environment that I see us navigating. And part of the reason that the responses were so big in this recession is because we're already, kind of stretched about as far as we can go in terms of debt and leverage in the system.
Yeah. So when you talk about debt to GDP, I mean, I know we're extremely high right now. Whatever, pushing 135%. I know something I've kind of looked at was like this Keynesian multiplier, where you kind of get into this debt spiral, or at least a debt spiral, where you're not getting the growth out of the debt that's been added. And it seems like, I guess, the Keynesian multiplier is like over 90% debt to GDP. Obviously, we're way over that. When we've seen other countries go past this 130 mark, like Greece or whatever, it seems like there's almost no coming back out of that. Have you seen the same thing?
So somewhat that's like a more it's one of those things where it's hard to prove causation there, because what you can observe is that there's strong correlation that as you get more debt, you also generally get less growth. And of course,
Right.
the tricky thing is it's saying that, are the reason that policymakers are taking all that debt out is because they have slowing growth, or is that debt causing the slower growth?
Okay.
And so I think the more fundamental underlying thing is demographics, and some of the fiscal decisions that some countries have made. But then on top of that, you can exacerbate that with certain monetary responses, things like that. And so overall, debt I view more as, what it's being spent on more so than the exact level. And as an example, if you look at, say, the interstate highway system under the Eisenhower administration, that was an example of a very a smart investment. You could call it big civil works projects that it boosted productivity, whereas other types of spending are sometimes less productive and therefore don't contribute to growth, but then they do contribute to debt. In addition, we can separate public debt from private debt because they actually have very different effects on inflation versus deflation. So if you look back, for example, in the 1930s and 40s, you had kind of a 1-2 punch at the end of a long-term debt cycle. So it wasn't like all the debt went up at the same time. Instead, you had a private debt bubble and then a public debt bubble. So the private debt bubble peaked in the really early 1930s, during the big crash and the Great Depression, the bank failures. So you had debt as a percentage of GDP from the private sector reach very high levels, while public debt was still pretty low. But then all the responses to kind of try to drag the economy out of that, create a lot of new base money, expand the broad money. Then you had, of course, you had populism, then you had World War II. So of course you had that kind of external fiscal response, and then therefore in the 40s you got that public debt bubble. And a
Mhm.
big difference is that the private debt bubble, especially as it unwinds, tends to be disinflationary, whereas the public debt bubble tends to be more inflationary. And if you fast forward to, the great financial crisis, in many ways that looked a lot. If you look at those really long-term century charts of the long-term debt cycle and kind of the fiscal and monetary, policy mix, that period looked a lot like the 1929 crash. That kind of private debt bubble coming to a crescendo, and then deleveraging, and then in the response after that, we had a kind of a mixed environment of certain types of disinflation. So you had goods disinflation, you had commodity disinflation, but then of course you had healthcare inflation, you had education, childcare inflation. So you had that
Mhm.
kind of mixed policy response. But then in the 2020s, now we're getting kind of the public debt bubble. We're getting kind of the 1940s environment of massive increase in broad money supply, massive increase in federal deficits to try to kind of drag the economy out of that. And that tends to be more inflationary in the grand scheme of things. So that's kind of how I'm looking that play out, is kind of monitoring private debt and public debt somewhat separately and seeing how they're interplaying with each other.
Yeah, I like that. It's such a nuanced discussion, right? Where, like you're saying, not all debt is good, and different types of debt, public debt, private debt, but also how that debt is used makes a big difference. So, to your point, Eisenhower building roads and bridges put a lot of people to work, helped build that economy back up. So that debt hopefully got more growth than what they spent. Whereas today, we're seeing a lot of debt seems like going into kind of black holes that probably isn't going to, relate or bring anything back. So to your point, it's very nuanced. And the inflation argument, or inflation versus deflation debate, is also pretty nuanced. I want to jump into that, but before we do, you were talking about, the debt to GDP, it's being high. I'm curious. It seems like, the markets really play a lot into that GDP as well, and maybe the Fed, central banks, have a pretty strong reason to try to keep those markets propped up, or that debt to GDP could even shoot way higher. Is there something that you're seeing there? Is that true?
Well, there's a couple kind of bottlenecks that they've been kind of bouncing around on. And so we saw that start to play out in late 2019, where they were trying to do quantitative tightening, but then they had that repo spike in
Yep.
September of 2019. And so the Federal Reserve was forced to abruptly stop quantitative tightening and shift towards quantitative easing. Initially, they didn't want to call it that, but they were expanding the balance sheet by buying T-bills.
Yeah.
And that helped put out the fire in the repo market, because ultimately what you essentially had was an oversupply of T-bills relative to reserves. So they increased reserves, by creating new base money to buy some of those T-bills and kind of, essentially monetize part of the U.S. deficit. And then it became more explicitly QE when you had the pandemic, because
Mhm.
prior to the pandemic they couldn't call it. I mean, you couldn't. You're right in the middle of an economic expansion. You can't say we're just expanding the balance sheet because for fun. We're just doing it for basically they didn't have the cover to say, yeah, we're actually doing it because we have a problem. Instead, once you had the pandemic, you can say, okay, no, well, now we have an economic shock, so we have to do QE. So they were more directly calling it QE at that point.
Right.
And then even then in March 2020, when the markets crashed, initially bonds did well. I mean, bonds sensed out that crash coming, bond yields went down, so bond prices went up. But during the heart of the crisis, as the dollar spiked, you had the foreign sector having to begin kind of forced selling some of their treasuries in order to raise dollars. And you had other entities then, with leveraged, kind of risk parity funds having to sell some of the treasuries. And so you actually had to sell off in the treasury market at the worst part of the recession.
Right.
And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries in 3 weeks to kind of reliquify markets. You had in addition to the yield spiking, you had the bid-ask spread just blew out. So the market was essentially liquid and broken, and it's supposed to be one of the most liquid markets in the world,
Right.
the treasury market.
Right.
And so they've kind of been flirting around the issue of finding out where these bottlenecks are, letting them play out, but then immediately responding very quickly. And so that's a different environment than, say, the 1930s as an example, and even a somewhat different environment than we had in 2008, 2009, which is that they're much faster when something breaks in order to respond. You can even go back a little bit further and look at 2018, that quarter four period, where the famous Powell pivot, where they said they're on autopilot, they said they're going to raise rates. You started to get a sell-off in the equity market at the end of the year. But then under the surface, you had no junk bonds issued for 6 weeks, right? So you had a complete freeze in the high yield credit market, and policymakers like Powell were aware of that, and so they were forced to basically shift more dovish. So that's essentially what their regime has been, which is responding to fires when they happen rather than kind of moving ahead of fires.
Yeah. So it kind of takes us into that next kind of inflation versus deflation, conversation. And again, I know that's a very nuanced discussion, but it seems like they're fighting deflation, but probably more like deflation of assets, right? So they keep saying they can't get the inflation they want, they can't get it. Well, I think they've got it now. I think it's a little bit over their target at this point, but um, but then at the same time, we're seeing prices of everything going through the roof, from used cars to used bicycles, all the way to all types of financial assets and all those types of things. So the deflation that they're afraid of, I mean, is that really in the markets? That's what they're worried about: stocks dropping, real estate dropping, bonds crashing, things like that. That's
Yeah,
what they're
they were.
fighting.
Yeah, well, they were pretty explicit, a decade ago when they point out that they wanted to do the wealth effect. So they pretty much said they wanted to cause asset price inflation.
Mhm.
They just described it a little bit more politely, and so that was their goal, was to basically increase housing costs again, increase the stock market again, and if you do a lot of monetary policy without doing a lot of fiscal policy, that's what you tend to get. Now there were still disinflationary forces over the course of that decade because, for example, about a decade ago, you had a period of commodity oversupply. You had the slowdown in China. And so we've been kind of working through this period of commodity oversupply for a while. We also, of course, had the rise of shale oil, which was largely unprofitable, but it still contributed to a ton of extra supply and therefore pretty low prices across the board. And so we've been in that kind of disinflationary commodity environment. While we had a target, inflation in asset prices, inflation in healthcare, inflation in education, inflation in childcare, things like that, where you had deflation in electronic goods, you had deflation in commodities, deflation due to technology and kind of offshoring, things like that. And so from their perspective, they would prefer the say the inflation rate to be higher than the treasury yields, right? Because that's how you can stop debt as a percentage of GDP
Mhm.
from continuing to grow out of control, if they have the essentially nominal GDP growing faster than the combination of debt issuance and as a percentage of GDP and interest rates. But of course, I mean, that's a really bad environment if you're holding cash or bonds. And so
Right.
there's no free lunch. I mean, someone somewhere is getting screwed over. Sometimes there are certain policy regimes where the debtors are getting screwed over, and there are other times where the people that own the debt, the creditors, are getting screwed over. And so
Right.
in this environment of high leverage, they're trying to err on the side of essentially the creditors getting screwed over. But instead of kind of abrupt kind of nominal losses, they'd prefer it, to basically just fail to keep up with inflation. And that's what you saw back in, say, the 1970s and 1940s, these inflationary decades. Ironically, they tend to deleverage things because the bonds fail to keep up with inflation. But you don't want to be the ones holding those assets, and that's a pretty big pool of assets.
Yeah, definitely. I guess that you kind of talked about that, and that's what I was trying to figure out is like, what are they trying to optimize for? Because to your point, electronics coming down and deflationary source things like that, and for I guess it depends on which side, as you said, which side you're on, but it seems like that would be good things for most people if prices were coming down. Asset prices, I guess, if you're holding asset prices, you want them to go up. If you want to buy them, you want them to be down, right? So I guess it depends, but like overall, it seems like if most people had their cost of living going down, that would be a good thing, and asset prices going up at the same time, that would be kind of a good thing. So I guess kind of the question was, are they really trying? I guess they're kind of targeting the CPI basket, which is like this consumer price of goods basket. But it seems like the big risk of deflation is in the markets. Like stocks could crash 50%, 80%. The real estate could crash 50%. And that's like a massive deflation hit. So you think that's what they're trying to optimize for? I mean, even though they're always talking about CPI?
Pretty much. I mean, they're trying to keep asset prices up. They're also, they're increasingly talking about kind of nominal GDP targeting. Again, trying to have nominal GDP higher than some of those interest rates and some of the debt accumulation levels.
Yeah.
And of course, the perspective will depend on if you're the monetary authority or the fiscal authority. So as consumers, we generally would prefer, price deflation while still having our jobs. So we
Right.
don't want some sort of economic contraction, but we want technology and things like that to lower prices over time so that our money goes further. And
Right.
that's normally the best case scenario. The only time that's bad is if you have a debt bubble, right? Because then the real value of your debt goes up relative to your incomes and things like that. So if you had avoided that in the first place, then that deflation is really good. But what policymakers are afraid of is that because we've had this kind of mix of lower interest rates and these different types of policy mixes, we've kind of encouraged this big debt buildup. And now, they basically have to, in their view, inflate it away before they can kind of stabilize. And so if you're the Federal Reserve, you're trying to hold yields lower than the inflation rate. You're trying to be accommodative, and kind of, trying to balance between, you know, uh, causing asset bubbles, but then also, not wanting to crash the market. So that's their perspective. And if you're fiscal policymakers, mainly you want to get votes every 2 years or
Yeah.
4 years or whatever the case may be, and you want to avoid, rising populism. You want to avoid, things like that from their perspective. And so depending on which side, where you work, essentially, if you're the Fed or if you're in the Congress, you have kind of two different things you're balancing.
Yeah. So the tools, as you're kind of laying them out, the monetary or the fiscal, monetary being like issuing more debt to the banks, monetary or fiscal, actually like putting money out into the streets into kind of people's hands. And it seems like, I mean, I guess as a central bank, what's the quote? If all you have is a hammer, the whole world looks like a nail. And they really only have a couple tools. And really it's, monetary tools. And so that's kind of like interest rates and increasing the debt supply, the money supply. But with interest rates, I mean, they're already almost down to zero nominally. We can talk about real rates, et cetera, which I do want to get to. But it seems like a lot of those tools, they're basically running out of, right? Interest rates are down to zero, debt's at all-time high, economy's not growing, so the debt to GDP is tough to move. I mean, do you see that they're like running out of tools? I mean, like how much further can this can be kicked down the road?
So for the Federal Reserve, I do view them as towards the end of their rope in terms of tools. And so they really only have two tools at the end of the day. Mostly it's interest rate manipulation and asset purchases or sales in some cases. And they have some other tools around the margin, like lending facilities and things like that. But ultimately, it comes down to controlling the price of money and buying assets. Now, the fiscal authorities, they're the ones that they can say send cash to people, but then they have to issue debt to do it. And so you have kind of, I've described it as like, if you have like a movie where they're going to launch like a nuclear missile and like two generals have to like put their keys in at the same
Right.
time. So I view policy tools and fiscal tools kind of like the two keys there when it comes to generating inflation. And so if you just have the monetary policy, that's not generally very inflationary on its own because you can't directly get money to people, right?
Right.
So the Federal Reserve can't send money to people. All they can do is control interest rates and they can increase the amount of bank reserves in the system, but then those get stuck in the banking system because banks aren't doing loans. And so you have reserves go up, you recapitalize the banks, but it doesn't actually get out into the public. On the other hand, the fiscal authority can send money to whoever they want as long as they have a consensus, but they have to issue bonds to do it. And then therefore someone has to buy those bonds, which sucks money out of the system. But
Right.
then if you combine the two and the Treasury sends money to people, they issue bonds, which the Federal Reserve creates new base money and buys those bonds and holds them forever. Well, then you're just literally essentially creating new base money and directing it into the economy. And that's how you get, say, the 25% broad money supply year over year change that we had, in 2020.
Yeah.
And so that tends to be a more inflationary environment, especially if they were to sustain it for several years. And so I think, as we go forward, obviously right now we're having some base effects, right? So we're in say March, April, May, June, you're comparing it to the 2020 period, which was like the kind of the disinflationary crunch they had during the worst part of the lockdown. And so
Yeah.
we're going to get some pretty high base effects. Like we're probably going to see, even official CPI, we're probably going to see it over 3% year over year. But then the big question is going forward, what are we going to do with, are they going to do like an infrastructure bill that also gets monetized? Are they going to do another round of aid, things like that? And some of those, if they were to continue, could be pretty inflationary to a certain extent, especially because, a lot of economists don't incorporate, say, the current situation of commodity markets. And so, of course, that kind of, say, 15-year cycle of commodity supply and commodity demand has a big impact on inflation. And so when you're in a period of commodity oversupply, as we were for the past decade, that tends to keep a lid on most types of inflation. Whereas when you're in a period of, say you haven't done a lot of capex, you haven't kind of brought new mines to market, you haven't found like new big, you haven't done the investment. If you were to get that increase in commodity demand, well then, you have higher commodity prices, and that's where we're starting to see that kind of show up in the market where many commodities are still below where they were 10 to 15 years ago, with some exceptions like beef, lumber, gold touched new all-time highs. Most of them are still below their all-time highs, but they're starting to break out from their big declining trend they had. And so it does look like the 2020s could be a more inflationary decade with tighter commodity markets, big increases in the broad money supply, and that money getting to people rather than just stuck in the banking system, which of course can benefit some people, but then you have that risk of inflation where you increase the broad money supply by a lot, but you haven't increased the goods and services by an equal amount.
Yeah. Yeah, we've seen that. We can see that in the precious metals market. I mean, gold and silver, right? The physical is very difficult to get, and it looks like, yeah, there hasn't been that much investment into that space. Which, of course, we've been in a long-term downtrend, bear market in that, so you haven't had that investment. So you're saying just a little bit of money would increase that demand, but then the actual physical wouldn't be there to back that up, which would then
Exactly.
push the prices up. Yeah. So That's a lot. I mean, we're getting towards the end of the rope. I think from an outside perspective to the casual kind of observer of the markets, right? You can look at like the 2008 great financial crash, which was obviously different, but I mean, it was a monetary crash. The financial markets crashed, but it took the stock markets whatever 6-7 years to get back to like their previous all-time high. Whereas now we had one of the fastest and deepest crashes in history, and it bounced back in months. Have they figured this out? Have they got it fixed? I mean, you have like obviously two different situations, but we have this whole, this whole pandemic that we're dealing with, which still keeps the economy running at a much lower rate than it normally would, as far as, restaurants open and supply chains maxed out, et cetera. But at the same, and then we have this whatever it is, 80, 90-year credit cycle that we're kind of coming to the end as well. Have we just skipped over that whole kind of reset of 2008 that we would normally see, and we're just going past it? Or do you think that's still kind of right there somewhere in front of us?
So I think it's somewhat different in the sense that back then, because we had, banks, for example, were highly leveraged, right? So if you look at how much cash they had set aside, they had, if asset prices declined by almost any amount, they were broadly insolvent. And so what you had was a real estate bubble. You had, really loose credit. You had a banking kind of highly leveraged system. So that all imploded, and that's the most disinflationary type of kind of outcome you can have. That's somewhat similar to what we had in 1929, except this time there was FDIC insurance and things like that. So
Because the debt can just go up in smoke just like that, basically. Yeah.
Exactly. Whereas then during the 2010s, banks had a very different situation where they because the QE happened, because the troubled asset relief program happened, they were essentially deleveraged, filled up with tons of cash, but then they still weren't lending it out. So in many ways, they actually had a very strong balance sheet because they had a lot of money plowed into cash and treasuries. And they weren't really lending it out. So it's kind of the opposite issue where they, instead of taking a lot of risk, they were actually playing it very conservatively. And so we went into this crisis. Banks weren't very leveraged. However, that we still had highly kind of vulnerable parts of the economy. So we had very high wealth concentration. So we had a big percentage of the population living paycheck to paycheck, and then we had shutdowns and things like that. So their income sources disrupted. And overall, a big difference between 2020 and 2008 is the size of the fiscal response. And so last time we didn't really print a ton of money. If you looked at, say, the bank reserves, they went up, they skyrocketed, but the actual broad money supply didn't really go up last time any more than normal. Like if you just looked at broad money supply year over year, you wouldn't be able to tell where that crisis happened. And so that's because our fiscal response was we had like cash for clunkers. We had we had little things around the margins, but we didn't just like hand money out. Whereas in
Right.
2020, we handed a lot of money out, so we actually kind of prevented some of those solvency issues. But the real limiter there is that if you were to get inflation while you have debt to GDP this high, they wouldn't be able to afford to raise interest rates. And so probably you get something like yield curve control, which is what they had in the 1940s, which is again why this policy mix is somewhat similar to the 1940s policy mix. And therefore you risk a higher amount of currency devaluation this time around compared to what they risk next time. So it's kind of like they're kind of playing with different sort of limits. Last time it was a more banking crisis disinflationary outcome, whereas this time it's potentially more of an inflationary outcome because you've disrupted the amount of supplies and services in the economy, but then you greatly increase the broad money supply.
So do you think they've sidestepped disaster, or before we get to that, let's not jump into that question. We'll come back to that. But you're looking at the macro picture, and I, like I said, subscribe to your stuff, so I see you cover a lot of ground. And so if we kind of take a step back, even bigger than that, I think when you look at the macro, we started out talking about these systems and kind of push pull and like policy response. So if we're looking at like a macro picture, we can see the world is also changing pretty rapidly. It seems like globalism is still kind of coming tighter and tighter, right? We see what the World Economic Forum is trying to do, but also like the IMF, and they're talking about, now there's this new SDR issuance that they're trying to get through. They've even talked about, rolling out their own digital currency and things like that. And so at some point we've seen the dollar de-dollarization of a lot of nations kind of falling down. And so there's a bunch of different levers out there, right? But I mean, the U.S. can continue their fiscal policies, which only hurts the dollar. We're already seeing the de-dollarization happening across the world, and now we're seeing the IMF kind of trying to roll out their own fiat currency that's like a layer above. So how do you take all that into consideration, I guess? And I guess maybe you keep a more global view than just a kind of a U.S. centric view on that.
Absolutely. Yeah. And to go back to your previous question, I think the risk here in the 2020s, basically the mix of policy responses, I think the biggest risk would be stagflation, which is a somewhat different risk than we had in the 2010s, which was kind of a stagnation, like kind of slow nominal GDP growth, and you had those issues play out. Whereas now, because the fiscal response is so bigger, instead of say a giant nominal, decline in asset values, I think the bigger risk is probably stagflation, where
Mhm.
you have broad increase. Sharp increase in the broad money supply, but then just various supply shortages and things like that. And then especially if you compound that with we basically made our systems very fragile. So going back to this global view, we spent the past 40 years globalizing the economy. So we've distributed our supply chains globally, and we basically made something that's very efficient, but then very easy to disrupt, very
Right.
fragile. Obviously a pandemic would be part of that. But then in addition, if you have, say, ties between the US and China continue to deteriorate, or
Mhm.
at the same time their economies are so intertwined, that if you were to get reshoring, you're basically taking away that disinflationary outsourcing they've done, and that's one of those things where that outsourcing was very bad for some people, whereas people whose jobs were not impacted by it benefited from it because prices
Right.
went down, but they didn't care because their incomes were still intact. So that led to all sorts of social issues, because then that leads to wealth concentration thing. If you're on the right side of that, you're benefiting. If you're on the wrong side, you're getting harmed. So if you
Right.
start to reshore that, then that kind of changes who's getting hurt and who's getting harmed. And so if you were betting on long-term deflation, and you're willing to have negative cash yields, negative bond yields, but then you actually start to get increase in the broad money supply, you start to get disentangling to some extent of globalization.
Hey, sorry to interrupt this video just one more time. I'm not running Google Ads, so it's actually way less interruption than I normally would have on a video. And that's because it's sponsored by BlockFi. They are opening up the world of Bitcoin and financial products, offering to pay you interest on your Bitcoin, better than owning a rental property that you have to manage and control and have the risks. You can just earn interest on it, or you can leverage against it. Now, I plan to hold my Bitcoin forever and literally never sell my Bitcoin. So how do you do that? Well, if I need money, I don't want to sell that Bitcoin. I'm going to pay tax on it. All right. I'm going to end up with less, and I don't have the Bitcoin anymore. So a better way to do it is to borrow against the Bitcoin. So I've put all my money into Bitcoin. If I want to buy a car or I want to buy a house, I can borrow against it at very, very low competitive rates, get my house, get my car, whatever that may be, and get to keep the Bitcoin. Now, I've done a whole video on this. You can find it. I'll link it down in the description below, how to retire off of Bitcoin without paying taxes. And you can do that with BlockFi services. I'll link to the video down below. I'm also going to put a link to BlockFi. If you choose to click on that link to check them out, you can earn up to $250 in free Bitcoin just for using that link. And that's it. Let's go ahead and get back to the interview.
And you get higher inflation risks. Well, if you're caught out with a pretty big bond portfolio, pretty big cash portfolio, that could be pretty painful, I think, in the 2020s. Whereas it was it worked out a little bit better for those people in the 2010s. And so I think that's kind of the biggest risk to be aware of, is probably that risk of stagflation. And then going back to kind of the changing monetary structure, my overall base case is to see overall kind of a more and more diversification of global reserves, in the sense that the percentage of global central bank reserves that consist of U.S. assets, like U.S. Treasuries and dollar-based assets, is probably going to continue to decline somewhat. Now, it still might be the single biggest chunk, but instead of, say, being 80%, it went down over time, and it's something like 60%, and that could continue to decline down to, say, 50% or 40%, which would still make it very large, as a percentage. But it does mean that some of those other areas are potentially growing their dominance. In addition, I think you mentioned the SDR
Right.
announcement. So it looks like we're probably going to get an increase in the amount of SDRs in the system. And so for people that aren't familiar with those, they're essentially like a currency unit that kind of represents a basket of five major currencies based on trade. And they've been around since 1969, but they've always been a very small percentage of global reserves. They never really caught on. And so
Right.
their full market capitalization is something like $200 billion, which is, it's a lot of money. I mean, you throw around a few hundred
Yeah.
billion, and soon you're talking about real money. But in the grand scheme of things, they're, yeah, the global official reserves are several trillion dollars. And so that's still a small percentage of global reserves. But they're talking about potentially increasing that by another 600 billion or so, which would, essentially quadruple the amount of that. And at that point, it's still not a giant percentage of reserves, but it's a more meaningful percentage of reserves. And that's a more kind of diversified, asset. That's the US dollar is less than half of that basket. And so that kind of continues the trend we've seen over the past couple decades of, gradual de-dollarization and diversification of these kind of different currency blocks. And then if you were to add on to that, China's rollout of their CBDC,
Right.
they're trying to internationalize their currency a little bit more. They're trying to bypass the SWIFT system, make themselves more immune to sanctions, be able to buy commodities in their own currency rather than go through dollar markets. And so we've already seen, the past couple of years, Russia do that as well, where they've sold their official treasury holdings. They mostly focus on gold and euro denominated assets, and then they kind of spearheaded selling their oil in euros.
Right.
To whether selling energy to Europe, energy to China, kind of using a broader mix of currencies that they're willing to settle trade in. And I think that trend's probably going to continue over the next 10 years. And, there could be sudden events along the way, but over time, it's, at the very minimum, I think it's going to be kind of a gradual transition that could be punctuated by big moves here and there, like, kind of the CBDC kind of fully going online or something like that.
Hmm. Yeah. So if they issue that 600 billion of SDRs, then they use those SDRs, they give them to different countries to put on their books as reserves, which then they have more reserves, which means they can create more of their currencies. But it's also when they do that, it forces all the nations, well, that are made up of that basket to increase their money supply, right? So, um, I mean, isn't it just like a giant circle? Like, what are the SDRs backed by? They're backed by the five nations fiats. But what are so then if those nations issue more fiat, what is it backed by? It was backed by the SDR reserve. So isn't it just like a big like circle?
Pretty much. I mean, yeah, from any one country's perspective, what they want to do is they want to have foreign exchange reserves. And so that can, I mean, it could consist of gold, which is a hard asset, but then, a large part generally consists of foreign, reserves. And so let's say you're Thailand, right? So you've, decades ago, they had that big crisis where their currency had a sharp devaluation, in the late 90s. And ever since then, they said, okay, we want to make sure that doesn't happen again. So they hold a lot of foreign exchange reserves. They hold dollars. They hold a diverse array of assets. And so if their currency were to weaken, they could sell some of those reserves and buy back some of their own currency and kind of tighten it a little bit. And so they've kind of built that hedge. But yeah, as you point out, the problem is everybody else has reserves. And so, in these kind of, these end of cycle, these long-term debt cycle environments, usually what you get is a broad devaluation. So they might all fluctuate against each other, but then they all go down versus something like, real assets. And so that could be, compared to various commodities, for example, and compared to other kind of scarce resources. And so, for example, if you look at, what happened during the Great Depression era, all currencies devalued versus gold, and it just became a question of which ones devalued more than others.
Right.
But they all devalued, and so I think we're in that environment in the 2020s where pretty much any currency, if you bought it in 2020 and held it, in a bank through 2030, you're probably going to be able to buy fewer products and services than you could at the beginning of that decade. And I think that's kind of my base case for seeing how it's going to play out, where in a short sense of it is that interest rates are not going to fully compensate you for the inflation that you're likely to experience over the course of that decade.
Yeah. Now, if we jump back to kind of that bigger macro view, do you also look at things like, social, political, societal factors, things like that? Maybe the rise of more Marxist type things, more control over the economy, things like that. Maybe, Biden putting us back into the Paris Accord, which now the U.S. has to commit to try to lower emissions more while other countries are committing to raise their emissions, things like that. I mean, do you take those types of things into your calculations?
Yeah, and that's part of the policy mix that I consider, and
Yeah,
and
that's
so
what I
I
thought.
kind of I kind of monitor those where there are certain environments that can reliably lead to populism, and then you kind of monitor what types of populism that is. And there's populism that can come on the right, there's populism that come on the left, and they tend to have actually a lot of overlap, even though there's different flavors of it. And then there's even kind of techno populism, like like Bitcoin, for example, I would say is a type of techno populism where it's people trying to take power back for themselves and trying to do this. And of course, you can have kind of low information populism and you can have high information populism. So whereas say from a established centrist politician perspective, they consider populism a bad thing. Whereas in reality, I think populism is kind of all over the board. Some types of populism are bad, some types are good. But either way, if you have that environment of, say, rising wealth concentration, you're inevitably going to get different types of populism start to come up,
Right.
and especially some of the really kind of problematic ones can be violent, and so that's kind of that plays into my policy mix. You might have read the book, for example, The Fourth Turning,
Sure.
and so that if you look at the fourth turning, I mean, all the ones that the authors identified, all those periods of time that they identified as fourth turnings, those also happen to be the end of long-term debt cycles, as defined by, say, U.S. debt to GDP, for example, government debt to GDP. And so those periods in time tend to mark very big transitions. Often there's currency devaluations, but there's usually restructuring of institutions, and so it really kind of takes just stepping back and looking out going forward and not having a linear progression and assuming what exists in the past decade is likely going to continue. You have to kind of start fresh and say what are things actually leading towards, rather than kind of discontinuing on the trend.
So then you would say that like a traditional financial advisor that might say, well, historically you would make 7%. Like those are kind of off, right? Like the world we're going into is probably not the same as the one that we're coming out of. At
I,
least not the current past, I guess.
I think so, and I think the past can still tell us things, and it has come down to whether or not you're kind of finding the right policy mix to even have an idea of what you're looking at. And so
Right.
I certainly wouldn't trust things to say, okay, looking back 40 years, here's what we can expect, and it's kind of like, well, 40 years isn't nearly enough to capture, kind of the full range of a long-term debt cycle. So
Yeah.
like I mentioned before, if anything, the closest policy mix I can identify is the 1940s. But there's
Sure.
not many financial advisors that are like, and if you look at the 1940s, you can see that, XYZ happened. But then even there, of course, there's still differences to be aware of. So it's
Yeah.
kind of like looking back to have kind of a framework for how this could play out, while still, kind of recognizing that things, could be quite different, and to kind of, have a framework to kind of navigate that over time.
Yeah. And to your point, you have to go back, I think, to the full cycle and then maybe even look at that cycle played out a couple of times to see how that cycle played out. It's something that I've actually been spending a lot of time working on these different cycles. And I'm kind of working on this thesis where like all these cycles are kind of converging at the same time. Obviously the Ray Dalio credit cycle, as you said, the fourth turning cycle, they're both like 80-year cycles that are kind of converging. There's one like this pendulum cycle where the world shifts from a we, which is like collectivism or globalism, and it shifts to a me, which is like an individualism or decentralization. And so it's almost like if you were playing, if you're bowling and you put the bumpers up, right, and the ball just kind of dings back and forth. But yeah, it's really interesting. You have to see those.
Yeah,
So
I've identified that somewhat as far as also labor and capital, because you have
okay.
these environments that are very favorable towards capital, and then you have environments that are very favorable towards labor, and they tend
Mm,
to push until they break something.
yeah.
And so if you push labor, labor gets too strong, then it's hard to get anything done. You tend to have more inflation, but wealth concentration tends to be low, but it gets to a point where it's not necessarily a good thing. Then if you swing too far to the other side, you have very high wealth concentration. You have people feeling that they have no autonomy, like they can be replaced by a robot, they can be replaced by offshoring, and then they start to have those more populist tendencies and kind of push the pendulum back. And
Yeah.
so society kind of, if you look back centuries, society in multiple countries around the world exists in that pendulum swinging back and forth between capital and labor. And I think the balance is kind of keeping it so it doesn't hit the extremes and kind of break the social contract, you could say, where then you risk kind of outright revolutions or kind of major changes, and kind of the society kind of negotiates keeping that pendulum in a way that that both sides feel like they have some sort of play in the system.
Yeah. Unfortunately, it seems like real change only happens when things get bad enough, right? So
Usually.
whatever that is, a junkie on the street or trying to lose weight or a relationship, it's like once it's like you can't take anymore is unfortunately when you normally take action.
Usually,
Um,
yeah.
yeah, I'm curious to just go back 1 minute. You had talked about the rise of populism, and you talked about populism on both sides, but there's some overlap there. So I'm curious what that overlap is. I kind of see like a lot of times it seems like, as you said, there's two sides, right? There's always two sides, and it almost seems like they're seeing the exact same problem, and maybe they're mad about the exact same thing, but it's just the solutions that they're asking for. Maybe one side thinks that there's less government's the answers, one side thinks that more government's the answer or something. What is that overlap that you were seeing?
Yeah, so pretty much. And it also comes down to what they think the government should do. And so actually, oddly, if you get far enough left, far enough right, one of the things they have in common is they want the government to do something. But then the question is what they want the government to do. And so on one hand, you have kind of like fascism. On the other hand, you have like, say communism or hardcore socialism. And so we've actually seen periods in Italy, in Europe and Italy, for example, where some of those far left and far right movements actually kind of make a coalition, which is funny because you think they'd be total opposite. But basically they're saying, okay, we have a lot of differences, but we actually have some similarities compared to the establishment. And so you actually kind of get that. I define it as like there's four quadrants. So there's like establishment left, establishment right, populist left, populist right. And so that's kind of a simplistic way of kind of saying there's actually in some ways like four parties
Hmm.
that in any given country are kind of competing with each other. And then of course you have different subsets of those groups. And
I
so yeah,
I look at it like it's interesting that you said like fascism and socialism are kind of on opposite ends and sometimes they could join. And I look at them as very similar. And so you do have all these isms, right? Fascism and communism, socialism and capitalism and whatever. And I kind of look at it just like two systems. So you have one that's like captured, controlled, centrally planned, and you have one that's like free, open, competitive. And like fascism and communism, or socialism, I look at all those as like a command economy, right? It's like a captured, like centrally planned economy. So maybe fascism and socialism are a little bit different, but they're both the same in the sense where the
yeah,
government, controls the means of production versus having an open competitive system.
yeah.
So it seems like I would say like both want the government to do something, but like some side would say, hey, we want the government to do something, which is get out of the way, right? Do less of it. And the other side is demanding more. And I guess they just they can't decide what they want more of.
Yeah, pretty much. And it's also, the funny thing is, if you look at in global politics, libertarianism is actually pretty rare. And so when you look at, say left-leaning politics in some areas, right-leaning politics, they often want the government to do something, but it becomes a matter of what. It's like, do they
Mhm.
want higher taxes, lower taxes? Do they want the government to regulate your social life more or less? And so, for example, one thing I like to point out is that there's very few states that are super low tax, and they were early to legalize cannabis, for example,
Right.
right? It's usually one or the other. Usually, like some of the high tax states also legalized it, whereas some of the low tax states were slow to do it. Some of them still haven't done it. And so it's actually kind of, we have 50 experiments in the United States, and in terms of they all can manage a lot of the aspects about their economies, but very few of them have chosen, say, libertarianism.
Yeah.
And that's an example that we see kind of worldwide, where you tend to see these kind of different elements where they tend to want government involvement, but then they differ on what exactly they want. Whereas, the libertarians rarely tend to get in control and be able to kind of enact the policies that they would prefer to have actually kind of lower government.
Well, I think a lot of that is one, it's like talking your book where like a pharmaceutical company isn't going to promote like a natural cure to something. They can't make any money with it. And
Yeah.
so what politician is going to promote less government? But I think it's also a change in the person themselves. So like I would consider myself somewhere on that side. I don't know. I don't like to use labels, but I just want to be left alone. Like, let me live my life. Let me take care of my family. Let me make my money. Like, that's it. Like, I don't want to go into a life of politics. Unfortunately, the people that do want to go into politics are
Yeah.
those people that want that, right? And we see that at the homeowners association or parent teachers association. I mean, any level you can
Exactly.
imagine.
Yeah.
And so maybe that's what it is. But anyway, but as I was just curious to get your take on that, because you do have to look at all that, because as you started out with the push pull, like it's that policy response that then has that kind of that jerk reaction. Um, I wanted to talk about two other things, so we'll keep it going. But one, I wanted to talk about gold. And so it seems like a lot of people are losing the faith in gold, right? It's like, man, whatever, 6 trillion, $7 trillion have been printed, CPI spiking, which not near as high as it should. We're seeing, as you said, commodity prices going through the moon. And if there was ever a time, I mean, the uncertainty in the world is high, populism is uprising. If there's ever a time that gold should shine, it should be right now. And it's been in this like downtrend. What are your thoughts on that?
So in my view, gold kind of follows two main things pretty closely. So one is the broad money supply increase, especially on a per capita basis. And then the second one is real interest rates. So say the 10-year treasury minus either inflation or say inflation break evens as measured by the TIPS market. And so treasury yields are 7%, then you're getting a 3% positive real yield. So even though inflation's kind of high, gold is not super attractive in that environment because it's actually in some ways better to have treasuries or bank cash. On the other hand, let's say inflation is 3%, but treasury yields are 1%. well, then you have a negative 2% real yield to hold something like gold. Say that the increase in the broad money supply, especially when you adjust it for, the new supply of gold, or a population increase, which actually tend to be about the same number, something like 1 to 1.5 to 2% a year, depending on where you're looking, what time period. And so by that metric, gold has done its job since say 2015, where we had a certain increase in the broad money supply per capita, you had a certain increase in the gold price, but it overshot it a little bit last summer. But then, so as we got, interest rates fell from, real interest rates fell from say positive 1% all the way down to negative 1%. But then they started bouncing back up, mainly because nominal treasury yields started to rise at a quicker pace than break evens did, and a quicker pace than official CPI did. So we got that that 8-month kind of correction in gold. But now I think there's decent indications that it's starting to kind of bottom out, and that real interest rates are probably due for another leg lower. Because now we're starting to get some of those more inflationary spikes coming through. So we have the low base effects, for example, pushing up year-over-year CPI changes. And as economies reopen, we're starting to see kind of more economic activity, higher nominal GDP growth, while interest rates are kind of still held to very low levels. And that tends to be a good environment for gold. And so it's one of those things where in any one of these kind of big environments, gold doesn't really go up in a straight line. So even if you look at, say, the 1970s, which you all know was an extraordinarily good decade for gold,
Right.
it actually had two major peaks. So of course, in the mid 70s, they had a really big peak, but then it actually had a giant correction, and that was correlated very strongly to real rates, because they did try to raise rates to kind of rein in inflation, and it worked for a little bit. But then you didn't really fully get it, and then as you kind of progressed later in the decade, you had another bigger spike towards the end of the 70s and into 1980. And so I view it as a similar environment now, where you're going to have corrections in the gold price, but that overall it's likely going to follow, say, the increases in the broad money supply per capita, and kind of follow real interest rates. And so I think that real interest rates might have had a local top and are probably due for another kind of lower leg down, which would be great for kind of commodities, and especially for gold.
Puerto Rico, gotta love it. So when you're talking about real rates, I mean, you're basically talking about the treasury yield, the 10 or the 30 minus the CPI, right? So is that right? I mean, that's what you're.
There are two ways to do it. One is you can do 10-year yields minus the CPI, and the other one is you can do 10-year yields minus the inflation break-evens rate, which is essentially the inflation rate that the TIPS market is pricing in looking forward. And that
Okay.
one gives you a more real-time assessment. But then, of course, it can be affected by Federal Reserve purchases of TIPS.
Yeah.
And so I look at both.
So you can see, as you said, like gold kind of overshot. So like August of last year, it spiked pretty high, and then right at that time, both the Dixie had crashed, but we also saw the negative, or the Treasury yields had dropped to like 0.5, and then all of a sudden started bouncing up to 1.5, and ever since then, gold's been in this bear
Yeah,
market.
pretty
So I
much.
mean that's one way to look at it. But I guess if you were investing into gold, then you're trying to guess into the future where you think those real rates are going to be. So what do you see in regards to that? What's your
Yes,
kind of forecast there?
Yes, my base case is that we'll have negative real yields, for most of the next several years, and that we'll probably see lower real yields than we saw back in August 2020, which means I think we'll see real yields that are lower than negative 1%. And of course, you can arrive that in a couple of different ways. Like if you had treasury yields of 2%, but you had inflation of 4%, well, then you're at negative 2%, which is much lower than we saw in August. If you look all the way back to 1970s, real yields got as low as -4 or -5% at times. And so I certainly think we can see results like that in the 2020s, where I think as long as gold kind of continues to be viewed by a pretty large segment as a store of value, that it has that kind of outcome. So I'm still bullish on it. I know that there's that kind of the heated debate between Bitcoiners and gold,
Yeah.
for example, and I've always been kind of on the both camp. I mean, I like both, and so I came from more of the precious metals background, but then as Bitcoin kind of proved itself over time, I became quite bullish on that, and so I think that they both can have a role in portfolio, because I'm quite bullish on both of them, and I view them as less so to some extent they compete with each other, right? Especially among younger investors. But if you look in the broader sense of the kind of the world, if you look at the amount of money that's stuck in cash and sovereign bonds, that is yielding below their prevailing inflation rates, that's a much larger pool of capital than
Right.
the full gold market capitalization and the full Bitcoin market capitalization by an order of magnitude.
Yeah. Yeah. I mean, I see what you're saying. I was a big time gold bug. I started to realize I was actually a sound money advocate. And so when I look at it from that lens, I mean, I still like gold, but I like Bitcoin. They definitely have their differences. I think I would say to your earlier point, you talked about Russia has been de-dollarizing and moving into gold. And so you see the sovereigns moving into gold, the central banks acquiring gold. They're not buying Bitcoin. But as you said, the younger generations, the retail investors, I think Bitcoin's outcompeting on that level, and gold's outcompeting on the sovereign level. And to your point, I think sovereigns are a much bigger market. But then we still have the problem with that price being captured and kind of being set in London every day. So we'll see what happens with that as well. But all right, that's good. So yeah, moving on to Bitcoin, then you've done some amazing work on Bitcoin, by the way. It's been great having you in there doing that analysis. And I know it did seem to take a while to kind of get you warmed up into it. And you've talked about that, right? How maybe over a couple of years you kind of looked at it again. What was it that kind of kicked you over the edge?
I would say two things. I mean, I analyzed it in late 2017 because whenever you have a big run up in something, you start to get a ton of questions from readers about like, hey, what about this? And so
Yeah.
I wrote my first research piece on Bitcoin, and I would describe it as kind of neutral to mildly bearish, where I wasn't explicitly bearish, but I didn't take a position. And I had a couple concerns. One was that we of course had that giant price run up, and you had a ton of euphoria, and I was like, whenever you see that level of euphoria, you have to be careful. And
Yeah.
then two, I wasn't sure about dilution among multiple different digital assets. And I was like, okay, so at that point we had kind of the alt season, right? And you had
Right.
Bitcoin lose its dominance. So it started out as obviously it was the first one, so it had 100% of the market share, and then over time it kind of went down to 90. And then during that full kind of say 2 year period, Bitcoin dominance went down to something like 40% of crypto asset market
Right.
capitalization. And so my concern was, okay, even if this whole market goes to a couple $1 trillion, if it all gets diffused among multiple protocols, especially at that time at Bitcoin and Bitcoin Cash had recently split,
Right.
and I was watching that, and I was kind of like, okay, if this splits enough, and if this gets diluted enough, then I'd be concerned about the idea of scarcity. That even if a protocol is scarce, it's got a finite number of units. If there's kind of multiple protocols popping up and competing with each other, then it can kind of dilute that effect.
Right.
But then, and that, in large part, that was correct, because then for the next, couple of years, Bitcoin, it had a blow off top, then it crashed, and it had this kind of highly volatile period of underperformance relative to, say, the S&P 500, relative to some other assets. But then, over those couple of years, my concerns are largely addressed. So one is when you had that consolidation, it took off the euphoria from the market. So we kind of took out the price issue. And
Right.
then second, uh, you know, uh, we had kind of that fork war was largely settled. And so
Right.
if you look at market capitalization, hash rates, number of nodes, the acceptance among kind of custodians or hardware wallets, or like whatever kind of metric you want to do to measure a network effect, Bitcoin retained almost all of that market share compared to Bitcoin Cash, Bitcoin Satoshi Vision, things like that.
Right.
And so overall, kind of Bitcoin solidified itself as the premier store of value asset, whereas these other protocols that come and go, show that they don't really matter to it. We also had the growth of institutional grade custodians like Fidelity and NYDIG. They kind of came out and they had more of
Yeah.
a foundation that when institutional money comes into the space, there's basically places ready to absorb that money. And we had also ongoing improvements in hardware wallets, software wallets, especially for Bitcoin specific ones. So we had kind of the break between Bitcoin and the rest of the crypto space. We had
Yeah.
Bitcoin specific companies, Bitcoin specific security products, and different things like that.
Yeah.
And so when we had that liquidity crisis in March and April of last year, I had been watching Bitcoin. I was like, okay, now it's perfect. And so I ended up, ironically, it was like the same price as when I analyzed it back in late 2017. But at that point, I viewed it as significantly de-risked.
Yeah.
And so I jumped in at like 7,000 a coin, and then I wrote a series of articles explaining, why I'm bullish, and just kind of emphasizing all the different, things that I think changed over this past couple of years, while still being aware that there are still some risks to be, kind of lurking out there, but that overall that the risk reward profile of it became very favorable, and it kind of hit that critical mass where I was like, yep, I think it's a good kind of emergent store of value. I think it's useful technology, and so I became quite bullish.
You've studied a lot of cycles. I'm curious if you've, gone back and looked at like the technological revolutions. I think there's been 4 of them in the last 250 years. And if you look at these technological revolutions and look at the tech cycles, they almost always follow that same pattern that you're describing. So you could look at the rise of the automobile and new technology. All of a sudden there's 50 auto manufacturers. Which one's going to win? Who's going to win, right? And then it got overbuilt for the market. The market couldn't sustain 50 auto manufacturers. They all went bankrupt. 3 were left. They gobbled up the technology cheap and they went on. Same thing we saw in the internet days in the 90s. And so kind of the same thing we saw play out in the blockchain space, where all these protocols, and then it seems like the winners have kind of emerged from that. So again, back to that history, those cycles just kind of playing through. It seems like from 2017 to now, and back to technology cycles, what's different is typically we would see new technology typically would be funded through VCs and institutions and funds like that. And this actually had this grassroots rise, right, where it went to the people first. And I think because of that, it allowed the volatility to get even higher because one, like a venture capital company, I mean, if I invest into a VC, there's no daily market for that, right? You don't see it. Yep. You don't see the price for whatever, 6, 7, 8, 10 years. This we saw it daily, but the makeup of the buyer was different, where they were retail hoping to make quick money. And then when it crashed, they were quick to sell. Whereas today, we have these institutional players coming in, the Warren Buffetts of the world that have held Coca-Cola since, 1965. Not that he's in, but the makeup of the buyer is different. You mentioned NYDIG and, Mass Mutual and on and on and on. Do you think that the makeup in the buyer and the evolution and the kind of growth that we're in has changed the cycles? I mean, do you see that like maybe those 85% drops of the past, maybe we're kind of past that, maybe we'll see 40 or 50% moving forward, or what do you see about that?
That would be my base case, is that as the market cap grows bigger, as the size of the customer base, like the user base grows, and that bigger pools of capital get in, I would expect to see lower volatility over time. And so I don't know the exact amount of drawdowns that we'll have, but I would expect it to be lower than before, which could be both the upside and the downside. And so when it was a tiny asset kind of exploring whether it's going to exist or not, you can have really huge price swings. But then as, say, institutions begin holding an allocation and rebalancing it, right? So that's a little bit of a volatility dampener right there.
Mm-hmm.
And then as it becomes more clear in regulations how it's going to be handled, whether institutions can get into it or not, which they now can, that helps smooth that out. In addition, even among the retail investors, we've seen a rise in the idea of dollar cost averaging into it. Companies like Swan Bitcoin and others that have really kind of emphasized that. We even have, credit cards and debit cards that pay you back in Bitcoin rewards. So we have this kind of mentality of, it's like people often describe the crypto space as the same thing as like, people buying Tesla, and other kind of, speculative stocks. But really, the Bitcoin community is somewhat different from all of that in the sense that, you have a bunch of like, say, Austrian economists on one hand. That's not the same like group of as like, say, people buying Tesla necessarily.
Right.
And then you have a lot of people that are kind of like diligently saving, every week into buying some sats. And it's just a very different mindset than, say, speculation. And so the combination of institutional ownership and that idea of like hodling and dollar cost averaging, I think that can somewhat smooth over some of the the volatility that we'll see. And I think, the longer term, I view one of the biggest kind of challenges to Bitcoin is it has to navigate that transition towards it's funding its security mainly through new coin issuance, the block subsidies,
Right.
to transitioning kind of towards fees always being enough to sustain its security. And I think that's kind of the last kind of final test for Bitcoin, other than maybe kind of a ongoing state attacks. Like we see some countries trying to ban it. So I think, besides kind of a major regulation and that shift towards fee-based security, I think the actual kind of user base is now a very good tailwind, where it's more likely to be held, more likely to be, even when people say they have a lot of it and they want to spend it, they might actually go and say, lend it a little bit, or they might deposit it and take out a small loan. And those sort of things can also limit the supply of coins coming to market. And so I think that overall can smooth out the market to some extent.
Yeah, great point. I recently just made a video about how to retire off Bitcoin, and it was just rolling it over, borrowing small pieces against it. And I was a real estate. I mean, I am a real estate investor, and it's no different than what we do in real estate either. I mean, you refinance your house, cash out refi. People do it all the time, so it's no different. So many people came out and said, "Oh, but the government's going to shut that down. You won't be able to borrow against it." And I'm like, they're going to shut down borrowing against assets. Like, doesn't make any sense. But I know we've gone pretty long here, and I appreciate you taking so much time. But I want to get into one more question, and we'll wrap it up. But so I back to Bitcoin. Being viewed as a risk on or risk off asset. And so obviously we don't know because we don't have that history. But if we look at gold, back in 2008, we saw the stock market drop 50, 60%. Gold dropped 25%. But it was the response, as you were saying earlier, the policy response to that, all that money printing. It pushed gold up. I mean, within 6-7 months, it reclaimed its high and then went on to new all-time highs. Whereas stocks, it took 6-7 years to reclaim its previous all-time high. So I'm curious what you think. I mean, if gold is any indicator, and of course we saw that again in the March of 2020 crash as well. Same thing with gold and Bitcoin. So I'm curious what you think moving forward, and it's speculation because we don't have that historical trend. But do you think that Bitcoin will be that kind of security? Is it still risk on? Do you think it would crash because of liquidity like everything else, but then rebound really quickly? What are your thoughts there?
I view it similarly to how I view, say, these big tech stocks. And so early on in their life cycle, they're risk on assets, right? Because they're more speculative. You don't know if they're good, how well they're going to do fundamentally. They're smaller, and so they largely are in some ways separate from the economic cycle, because what you're mostly looking at is their own growth rate. And that's the same reason why in this pandemic, tech stocks initially did better than value stocks, because value stocks are more tied to the actual economy. Whereas tech stocks, they still grow their user base regardless of what the economy was doing. In some cases, even better if everyone's shutting doors and things like that. And so with Bitcoin, it's largely following its own adoption curve. So it's kind of, it has these cycles around itself, largely due to the halving cycle, but it's mainly following its adoption curve. It's kind of it's being monetized. We're watching something be monetized in real time over the course of the past 12 years. And so, right now it's largely been more of a risk on asset. It's been more of a, benefiting from higher inflation levels, benefiting from growth, and kind of being punished when there's liquidity problems in the market, right? So like we had in March 2020. Whereas, if it were to get large enough and ubiquitous enough, then it can become more of a defensive asset in a similar way that say gold is, where people can flock to it in times of concern, rather than sell it at times of concern. And that's also where, if you look at, say, even in precious metals, if you look at what paper gold does during big liquidity problems compared to physical gold, they
Right.
actually behave somewhat differently. And so I think overall, as Bitcoin gets big enough, it does get more of that defensive characteristics in a similar way that a lot of those smaller growth stocks, once they became trillion-dollar companies, they become in many ways viewed more defensively, where people say, okay, if there's going to be slow economic growth, I want to be in Amazon, for example. That's kind of the mindset that the investor got, was they say, okay, I want to be in the big ones that I know that they're going to be around for a while. And so I think that as Bitcoin gets that kind of critical mass, it cools out and becomes less and less of a risk asset and more of a money asset.
So to make you, put it out right here, I'm not going to make you pick a date and time or any of that timing markets, but I'm just curious, if, or I should say, when we get to like another market crash timing, whenever that is, 18 months or 5 years from now, you said if Bitcoin gets big enough. So timing, when you think the next market crash could happen and where Bitcoin will be at that time, how do you think Bitcoin will respond to the next market crash? You think it'll be big enough to withstand that, be that Amazon player?
So my base case is that, as something that's still, by that point, let's call it a few $1 trillion. I still think it could be quite vulnerable to any sort of liquidity issue, especially if people need dollars, right? So institutions need dollars. They're margined. They sell what they have, not necessarily what they want to, and so they can still, but sell Bitcoin. But I would expect to see is, maybe Bitcoin not go down as much as it did in March, right? So if you look at, say, the March activity of last year, you had gold go down by a certain amount, you had silver go down even more, you had Bitcoin go down even more than that, and some of the altcoins I believe went down even more. But as Bitcoin gets bigger, I'd expect it to, say, act more like silver in that environment, so a little bit less extreme. And then as it gets a little bit more bigger than that, I think it'd act more like gold in that environment, where it might go down in nominal price due to liquidity shock, but that it goes down less extreme.
Yeah. Okay, great. Well, thanks for answering that question. You've given us so much. We've gone through a lot, and I appreciate you taking that time. But we'll go ahead and wrap it up, I guess, with that. I want to go ahead and make sure we're going to link to your website and the stuff that you do. Like I said, I'm a paid subscriber, so I recommend it to everybody. Anything else that you want to shout out or have people follow?
No, so I appreciate the conversation. So I'm at lynalden.com for people that want to find my work. I'm also on Twitter at lynaldencontact. And as we showed here, I mean, I cover equities, I cover macro, precious metals, Bitcoin. I try to go wherever kind of, whatever makes sense for that time, where the trend's going. And so that's, one of the few edges that a retail investor has is that you can go almost anywhere. Whereas if you're an institutional investor, you're often siloed into certain asset classes.
Yeah.
And so the best investors can do is kind of take advantage of that, the few advantages they have over some of the big money pools.
And it's more important than ever, I think, now to really stay on top of that and what I call tactically manage that, because I think those days of buy and hold are probably gone, at least for right now. Right, we're in a different time. So with that, we'll go ahead and sign off. Thank you so much, Lyn. Appreciate it.
Yep. Thanks for having me.